the Fed. This guy here, our guy, Jerome Powell, he has raised interest rates 0.5%. He did this on Tuesday, the 13th of December, and ever since then, the market's been weak. I'm going to go ahead and play just 30 seconds of this video that highlights some of his key remarks.
A half percentage point, though we have more work to do. Continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We're continuing the process of significantly reducing the size of our balance sheet. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low. The labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. Inflation remains well above our longer-run goal of 2%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%.
So as you can see, quantitative tightening, the Fed's starting to reduce their balance sheet. So all of the things that were pushing us up in the previous 2 years where the Fed was buying bonds, now they're selling bonds and letting the bonds roll off. So that's creating a tighter financial condition. They're also raising interest rates, which is going to cause interest rates on cars, homes, credit cards, everything to rise. And of course that means that consumers, businesses just can't buy what they want to for the same price of financing. So this is one of the primary reasons the market's dropping, but it's not the only reason. Let's dive into reason number 2, tax loss harvesting. So unlike last year, where towards the end of the year people were holding on to their stocks because they didn't want to pay taxes at the very top, this year, as stocks have gone down and people have losers in their portfolio, they want to get rid of those losses such that they can offset their capital gains on their other positions. So this tax loss harvesting will actually cause stocks that have been declining recently to decline even more as people want to book those losses for their taxes. So that's reason number 2. Reason number 3 plays into this a bit as well, and that's the concentration of ownership in stocks. And so I'm just going to show you our heat map. So this is a 1 week performance, and you see that all of the big tech names, all of the popular stocks with people have been going down. And these are the ones that are affected by the tax loss harvesting. But you're noticing the stock market's not all down, right? And this is actually accentuating the tax loss harvesting, especially when you look at the longer term performance, like if we look at 6 months performance. So, if you have gains in energy or healthcare, aerospace, industrial, and you have losses in tech, then you're likely to harvest those tax losses in the names that have been hurting. And some of them have hurt a lot. Tesla's down in the last 6 months, almost 50%, Amazon 25, 22 for Google, Microsoft 10, Apple 7. So there's definitely a lot of tax loss harvesting to do. And so until the end of the year, there's a likelihood that that'll create pressure on these popular names. I'm interested to see what happens at the beginning of the year to see if this reverses at all. So that leads us into reason number 4. People are expecting a recession. If you look at this Reuters article, most companies, most consumers are actually anticipating for a worse economic condition next year. That means less people are interested in buying stocks, and people are saving, and well, actually they aren't saving, they're all out of savings, but people are hurting stocks, and in adding new money to stocks is just not in the cards, and people are reflecting the valuation of companies going into a recession. That brings us into reason number 5, and that is China. COVID cases in China are exploding and leaving streets empty, factories empty. This means that there's a chance that there's going to be less goods produced. And as we saw recently with inflation, whenever there's more people chasing fewer goods, the prices of those goods go up. And so everything that the Fed is trying to do to fight inflation will be hampered by the way that the COVID situation is being handled in China. So the worry is that that'll continue to have upward pressure on inflation, and that the Fed will have to continue to fight that with ever higher rates. Finally, reason number 6 is technicals. We have this longer term downward channel that the stock market's been trading in, and we hit the top of the channel. Our MACD rolled over, RSI rolled over, and when that happens, from a technical standpoint, especially this 9/21 day cross, the markets start falling. So that begs the question, how far down are we going to go? Well, in the short term, for the S&P 500, I think we could go down to the 355 range, certainly, just to test our most recent lows. But that's not necessarily the bottom. If we switch over to the QQQ, which represents the NASDAQ 100, I've done a few projections of scenarios. And some things I'd like to note on this chart is, one, our long-term channel bottom. So I suspect, regardless of these scenarios, if we do get all the way down to the, we'll say the 230 range, we're definitely going to bounce off that range, regardless. Now, depending on if we're in a recession, if events spiral out of control in other ways, if Taiwan's attacked or something crazy, we definitely could go much lower and hit some of these prior periods from just a few years ago, right? The pandemic was just here in 2020. Definitely the top of that market right there. That would be another key area to bounce off. So that coincides with the likely intersection of our long-term bull. But certainly we would also have key levels here that we would bounce off of. This is kind of the worst case scenario. My medium case scenario is that we come down and we tag this longer term bullish trend. And I'm hoping for that one. Obviously, if tax loss harvesting stops at the end of the year and Ukraine war starts to come down and inflation seems to magically stop, and the whole world is just fine and great, there's a chance that we could pull up out of it a little bit sooner. But I kind of find this scenario a little less than likely. So part of the technical picture is zooming out and looking at the long-term situation. So if we're looking at the S&P 500, here's a chart that goes all the way back to 1993. And you've heard of the party like it's 1999. Well, this is 1999. This is what the party looked like. And then we went into a recession and the dot-com bubble burst. And here you have the 9 and the 21 month moving averages. And you see here they crossed. And then we head down for a good year, almost 2 years. And then we had the 9 and 21 month cross again. We did just fine for a long time until the next bubble burst. So this was the housing bubble. And with the housing bubble, again, we had the 9, 21 month cross. And this was a very steep recession, a deep recession. And as you can see, these create huge buying opportunities when you get to the bottom. But as you can notice, this is the everything bubble. This is what low rates, this is what infinite stimulus got us. And all that's being undone by the Fed, that's being undone by a weaker economy. And so this 9 and 21 month average, they crossed. And so my expectation is that this will come down. And again, S&P 500, some of these key levels we talked about here. We also have the 200 month moving average, which I just kind of extrapolated out here. And so there is a potential, as we've almost tagged it after the dot-com bubble and we broke through it in the housing bubble, I think there's a chance that we come down into this range and either come close to tagging it, or perhaps we do tag the 200 month moving average. We shall see. That would be, again, not a great scenario. That basically means that we lose all of the gains until basically the bottom of the pandemic. But that being said, you have to ask yourself, is the economy really stronger now than it was before the pandemic started. So just leave that thought for a bit. If any of this was helpful, please check out these other videos, like and subscribe so others can see us too. Thank you.